Yeah, great to be here. I'm Vice President of Exploration with CanCambria, and I'm going to give a really brief overview as to the company's flagship asset in Hungary. We're really excited to be in a really high-profile European tight gas space. Let's jump right in. Forward-looking statement. So the company is really engaged on a pretty significant growth path here in the near term. We are, I say, exploration and production. We've been focused more on the exploration and appraisal phase of the project here over the last 2 to 3 years. But pretty quickly, we're moving hopefully into this production phase of our operations. We're looking to drill a new appraisal well here later this year. We see Europe as probably the most profitable market right now. And so we're really excited to be in that space. We have a really experienced leadership team who've worked right across the spectrum, small, medium, and large companies, both service companies and operators. Our CEO is Chris Cornelius. Myself personally, I've worked as subsurface director for around 15 years with Pioneer Natural Resources. They made headlines recently, just sold to ExxonMobil for close to $60 billion. My role at Pioneer was subsurface director, both Eagle Ford and also the Permian Basin, which is probably the world's largest unconventional asset. At Pioneer, we had small asset teams, and we typically grew these resource plays from zero production, which is where we sit right now with our Hungarian asset, all the way up to huge shareholder growth. With the Eagle Ford, we took the company from $40 to $100 per share, and then with the Permian Basin went on from 100 to 200. So I have a track record of value creation, both on the appraisal and drilling and producing wells, vertical and horizontal. So what are we focusing our efforts on at present? I gave you a brief introduction to the management team. Really a couple of key fundamentals for us. The location is the most important, not just the profitable markets, but we also need a cycle time of a project 3 to 5 years from concept to first production. What that means is not only do we need to be high level execution, but we need supportive regulatory and government support, energy ministry support. And we certainly have that in Hungary. It's a great place to operate. They really are pro E&P. And without that, we would probably struggle to achieve some of the aggressive timelines that we have. The asset clearly also important. I've termed it a brownfield site in Hungary. It's a proven basin, and it has a number of oil and gas wells already drilled. It's a deep, high temperature, high pressure system. Most of those wells were drilled in the late 80s and a handful more recently, but all of them did not take advantage of the technology that we have available at the present day. So that really is the key for us to unlock this resource, is the application of technology. And it goes without saying, we need scale, unconventional resources. Once we prove commerciality, then we want a long runway of additional low-risk drilling inventory. And we have somewhere in the region of a 10-year inventory in Hungary once we get up and running. So a little more about the location. We're exploring in the Pannonian Basin. You can see the inset maps to the right-hand side, first and foremost showing the location of Hungary, and then the pipeline infrastructure on the far right-hand side. It's a proven basin, having produced many billions of barrels of oil and gas. High temperature, high pressure. We're primarily looking for gas, but we do have a condensate revenue stream also, which will kind of give us a little bit of insulation as to the volatility of the natural gas pricing. As I mentioned earlier, Hungary is very pro E&P. For example, we permitted our 3D seismic survey over a period of weeks, and we were thinking maybe it would have taken months, like in the US, but no, it was a very quick and efficient process to get that 3D approved and executed on the ground. Similarly, we have drilling permits in hand for the first 2 wells that we look to spud here later this year. So a very supportive ministry. As I'm sure you're aware, natural gas prices are robust. They even appear to be elevated here recently, hitting 2-year highs. And we could spend, we could spend a lot of time talking about the natural gas space supply, etc. in Europe. We don't have time to do all that, so I'll just hit one or two high points. The illustration, the gas price comparison chart to the right, gives you an indication of why Europe, the prices are trading at a 500% premium from the US to Europe, and that's, if you can get in and operate, that's really the premier location to be in. So in terms of kind of the energy landscape, we talked about we've got a cold winter in Europe, so storage is down, so prices are up. But macro scale, of course, the Russia-Ukraine conflict, a lot of the pipeline capacity has changed from Ukraine to other areas, and Hungary in particular still gets quite a bit of gas from Russia via pipelines to the south. But there is a significant demand in country, and we are looking more towards energy stability, affordability, and supply, rather than, we don't want these prices to spike like we observed back in 2022. Hungary does import around 70% of its natural gas. LNG is becoming increasingly more significant, and we don't feel that that's really a longer term solution for a number of reasons that we probably don't have time to discuss. Long story short, we see pretty good pricing for natural gas. Our project economics were all run in the $10–11 per MMBTU window, so we don't look to $16 or $17 present price as something that we need to make the project fly. So some key metrics on the asset itself: we have 100% ownership of around 30,000 acres. That is the map on the upper right. The irregular red polygon is our ownership. It's a production license held. We have a 25-year ownership, so there are no hard deadlines. Within that area, you can see a structure map, kind of from blue to red. That is the most highly prospective area. That's what we call the Kiskunhalas fault block. It's around 8,000 acres under our ownership, and the majority of that is prospective. Essentially in the green and the red areas is the highly prospective area. Now, the company has no production or proved reserves at year end, but we do have an audited report, 51101 report, which gives us a risk recoverable contingent resource in excess of 760 BCF and 71 million barrels of condensate. So as you may be aware, these unconventional resources are large. The resource base here is large. Now conventional accumulations, typically smaller, easier to produce. We need the technology, both the appraisal, characterization technology and the production technology, to make these fields commercial. And one thing that works in our favor here is the Hungarian Energy Ministry. They see that same need. A lot of the remaining resources in country is unconventional, and for that reason, they give a 98% net royalty interest to unconventional assets. So we get to keep the vast majority of the oil and gas that we look to produce. There are, as I said, 3 legacy wells within the field, 2 of which tested gas, 1 of which produced gas to sales. We have a pipeline very close by. Infrastructure is good. What we recognized when we did our desktop study back in 2022 was the need for a better subsurface characterization. We were modeling and were confident that a new seismic program would illustrate the fault blocks, the reservoir, and the distribution of the reservoir, and would explain the productivity trends and the distribution of the old legacy wells. And that's essentially what we found with this new 3D. We funded the 3D while we were private. It was around a $4 million US investment, but it really has changed the entire landscape of the basin. The most meaningful output from that technical work program is around a 50 location drilling program based on 40-acre spacing. And the 40-acre spacing is essentially what we've learned from analogs in other basins in North America. Pinedale being one good example of these vertical wells, multi-stage fracs over several pay zones. Of note, at the very bottom here, we're seeing finding and development costs a little higher. It's more expensive to do business in Europe, but not significantly higher than the US. 250 versus 125, and the margins are good when you compare the F&D cost of 250 to the natural gas price we realize at the moment. The outlook for the margins, etc., is really, really positive. In terms of what the project might look like going forward, this is one of a whole series of models, production models that we've ran on our 50-well development program. Really the key takeaway here is rapid and early production growth. If we're successful on that first series of wells, we have a peak production of around 25 BCF per year, which is about half the domestic production of Hungary, which is really a big number. That is peaking at around 2034. And then you can see once we stop drilling, that 50-well program is 6 wells per year. Once we quit drilling in 2035 to 2036, you have that natural decline. The inputs for that model that you see, classic tight gas decline curve, 7-8 million a day IP, rapid decline, and then a hyperbolic, which is the analog wells here are modeled on Pinedale. The good news here is wells pay out relatively quickly within these prices within a year. In our production model at $12 gas within 18 months. And again, the NRI is a really big thing for us at 98%. I've not seen other areas, other plays, other basins that have that. So just a quick comment on our near-term operational plan for last year, this year, and next year. Last year was a lot of fun. We were interpreting the seismic and seeing some really meaningful technical milestones. This year is all about planning and raising the funds to drill that first well, which we hope to spud Q4, and then hopefully an additional 2 wells in 2026, and then the development phase. CapEx for the first well around $20 million US, and that takes us from where we are today right through flow testing and production, which will probably be in 2026. So here, the investment highlights to wrap this up. We have a high quality asset, 100% working interest in a very strategic market, very profitable market, a very pro E&P friendly place to do business, and a compelling growth story once we get operationally executing our plan and drilling those first wells. What that looks like in terms of resources to development phase, the 50-well program, we're looking to produce somewhere in the region of 300 plus BCFE, which would be, if you're looking at LNG tankers, maybe 100 LNG tankers that don't need to come into Europe. So that gives you sort of a metric. Once we are successful, low risk inventory with scale, we see a positive cash flow model for many years to come. And also the team, we've done this before. We've done this before in many different basins. We know what opportunity looks like, and we have a shared value, a shared vision of what success looks like for the corporation. So yeah, with that, I'd be happy to take any questions. Thanks for your attention.
I'm glad I didn't unmute myself, so I'm glad you didn't hear my comments, because I was like, well, those are big numbers. Let's talk about some of those old historic wells that were plugged, drilled, and you talked about one of them was producing. What happened to that well, and what were the flow rates like, and why didn't it economically work back then?
Yeah, the 2 key wells that we lean upon, one drilled in the late 80s. It logged about 100 meters of high quality tight gas pay, and they performed what we call a drill stem test, where they produced naturally, and it produced for a very short period of time about 1 million cubic feet of gas a day. But back in the 80s, they were not interested in tight gas, so that was essentially abandoned. A well drilled in 2008 came in and offset by around 600-700 meters. Unfortunately for that operator, the wrong side of the fault block. They came in and they produced around 3 million a day, and that declined over a short period of time. And they produced into a gas storage facility for around 6 months to hold the acreage. That was not part of really CanCambria. They only had around 2 to 5 meters of net pay in that well. So you can imagine they were very disappointed that they didn't replicate that initial 1980s well. The good news for us is, even though that well, the more recent well, didn't have much pay, it did produce, and it was very easily completed and stimulated. So the key risk when we came in is, how do we better identify the reservoir? That's the main problem. So our 3D seismic and our seismic inversion and our technical work program really explains those wells. We can see sweet spots within the reservoir. What I always told my investors was that just because the good well has 100 meters of pay, my guess is that's not the best of the best. There will be other areas of the field that are better, and that's what our seismic has told us. It's identified areas that we want to stay away from and good areas that we want to high grade and position the new wells. So yeah, we have a tool that has de-risked the most prospective part of the basin. Hope that answers your question.
Yes. So I can imagine seismic and IP is like vastly improved over the last 20 years. Talk about how completion methods have changed and like how understanding of getting into these tight gas plays and unlocking the resources has changed over the last 20 years.
Yeah. The technology from many basins in the US, what used to be, especially these high temperature, high pressure completions, used to be quite an exotic experience. No, this is a pretty straightforward run-of-the-mill completion. We're looking at 6 to 8 stages. All the horsepower that we need, all the services are within Europe. We've probably will benefit from completion design parameters from Pinedale, where they isolate individual sands. We do what we call a plug and perf operation, where we fracture stimulate the intended zone, relatively limited entry, quite a high rate, what we call a slick water stimulation, where we pump water and a little bit of proppant, and we do that over, as I say, 6 to 8 stages, and then drill out the plugs and flow the well back. I think some of the things I've learned over time is the drawdown on pressure is important. How we manage the well in the early life is important, so that we can produce it without any formation damage, and then monitor pressures to see. What we don't know is really the drainage area, the stimulated area. There are some tools you can leverage to give you ascertain the drainage area. We're saying 40 acres. 40 acres may not be the appropriate drainage. We may be able to tease out and recover more gas as we go to tighter spacing, but we won't know that until we've started operations in the area. In Pinedale, they recovered their wells were 20-acre spacing, and they were recovering incrementally more gas at 20 acres. And as long as the project is economic and we can drive down well costs over time, so the 20 million for the first well, that's not going to be the cost of a development well. Once we sign longer term contracts and we have efficiency gains from pad drilling, we're hoping to get that price down near 14, 15 million US.
Okay. Well, we're out of time, Paul. That was excellent overview. Thank you very much for your time. Obviously we'll be watching how you finance this project moving forward, because that's a big play, very big play. And
Yeah.
you certainly got a pretty group of smart guys behind you on this deal. So let's see how this one unfolds.
Thanks, Arlen. Appreciate your time. Thank you very much.